Okay, welcome to the iNet Young Scholars Initiative Fourth Price of Money or Price Level Discussion Group. Joining us today, we have featured guest Richard Vague. Richard is Acting Secretary of Banking and Securities for the Commonwealth of Pennsylvania and serves on the governing board of iNet. He is the author of A Brief History of Doom, a chronicle of major world financial crises. He's also the author of The Next Economic Disaster, a book with a new approach for predicting and preventing financial crises. And he's also written about debt jubilees, private debt, and more generally about money, banking, and financial stability. Richard has a forthcoming book entitled An Illustrated Business History of the United States, which is going to be hitting the Amazons in less than a week on May 21st. The book looks really cool, and I'm looking forward to checking it out. He also, as he just let me know in the before talk here, has a book about debt jubilees coming out through Polity Press. It's going to be later this year, so I'm very excited about that one as well. But the reason why we're here today is that Richard published a 2016 article on the iNet blog entitled Rapid Money Supply Growth Does Not Cause Inflation. We read the article, so now we're here to discuss it. Thanks so much for joining us, Richard.
It's a real privilege to be here. Thank you for having me.
Yes, and Richard's colleague from the Governor's Woods organization, Dan McShane, is also here, and we're excited to hear your thoughts as well, Dan. Given the size of the group today, I'm thinking we can keep the discussion fairly informal. We'll likely to be able to get to questions from anyone who has one. If you have a question you'd like to ask, feel free to poke me in the chat. I'm going to start us off by asking a question. So Milton Friedman, of course, famously said that inflation is always and everywhere a monetary phenomenon. What does that mean? And why is it wrong? If inflation is not always a monetary phenomenon, what kind of phenomenon is it?
Well, thank you. And first, let me again say what a privilege it is to be here, Alex, and thanks for all your great help over the last few weeks. And I want to give a shout out to Jay Pocklington, who I've been a huge fan of Jay's for years and years. We've had the occasion to work together a few times along the way. But Jay, you've just done a spectacular job with YSI, and we're grateful to you. But yeah, Milton Friedman makes the statement that inflation is a monetary phenomenon, which basically means if the money supply grows a lot, then you're going to have a lot of inflation. And if it grows a little, you're going to have a little inflation. And they're correlated. And, you know, I think it's true even today that if you talk to, you know, whether you talk to the business person on the street or economists, you know, 99 people out of 100 are going to assume that statement is true. I mean, I've rarely seen an idea become as deeply rooted as the idea that money supply growth causes inflation. So, you know, going back to that period, Dan and I just thought, you know, since we have developed this database of 47 countries, and we have, you know, a lot of economic data on those 47 countries that goes back, you know, to the 60s and 70s, and in many cases goes back a couple hundred years. And we decided, why don't we just check this out real quick? Because that seems to be a very simple thing to check out. You just go across the 47 countries and you pick some definition of high money supply growth, you know, 3 years of 50% per year growth, for example, seems like a high money supply growth. And then you see whether high inflation follows it or not. And so we just assumed we'd validate the premise and move right along and, you know, have some comfort in the premise. And turns out it wasn't true. It wasn't even remotely true the first time we ran it. You know, there were plenty of times where inflation didn't follow high money supply growth. And conversely, there were lots and lots of times where high inflation growth was not preceded by money supply growth. So we assumed we'd done the analysis incorrectly. so we changed it. And instead of 3 years, we used 5 years or 1 year or 2 years. And instead of this definition, we probably ran, I don't know, Dan, you know, 10 or 20 different permutations of this. And every time we did it, the same result came, which was lots of times money supply grows rapidly and is not followed by inflation, and lots of times high inflation happens that is not preceded by high money supply growth. So, I've basically come to the conclusion that inflation is never and nowhere, a function of the money supply, and instead, there's very specific kinds of inflation. One of the most important, if you look at U.S. financial history, and we have a database that goes back to basically to the 1790s. So we have 200 plus years of U.S. Financial history, and you get inflation in the 2 or 3 years after a war. That's when you get inflation, and it's supply disruption inflation. World War I takes out 30 or 40% of all the farmland in Europe. Well, guess what? The price of food goes up dramatically. I think we're seeing something along those lines right now. A great deal of supply disruption. There's also, we observe that developed countries, which is where we spend our time. We spend our time looking at the 6 biggest countries in the world that together constitute, 40 or 50% of world GDP. And you just kind of don't have inflation of any particular note in large developed countries. You tend to have it a lot in small, much less debt-laden, much more rapid population growing, smaller countries. And we haven't really explored that as thoroughly as we want to, but that'd be one of the places we'd look.
Very cool. So I didn't realize, so are you saying you were basically a believer in the money supply growth causing inflation until you did this study? You didn't even have a hunch that it might be wrong. You just kind of wanted to confirm.
That's exactly right. I came up, I was a banker in the late 70s and 80s when, Paul Volcker was a demigod and Milton Friedman was, dominated the economic landscape. And, we took it as a given, the sun rises in the east and money supply expansion causes inflation. There's a few truths, and it didn't. We never had occasion really to examine it, but we have a lot of fun with this database, and there's a lot of things that people say that are easy for us to check out. And I don't think most folks have as comprehensive a database as they should, nor as rigorous as they should be relative to actual data. So we use that a lot for that kind of exercise.
Okay, fantastic. Let's go to a question from Natalie.
Oops, thank you for your comments. So my question relates to this whole thing that we are discussing, because some papers that we read in this group actually start by saying that inflation is a real phenomenon that manifests itself monetarily. So this cost push inflation theory. And in your paper, you make the claim exactly that that inflation is not a monetary phenomenon, but you don't have this theoretical literature. So I was curious, what theory do you have in mind? What kind of transmission channels do you have in mind? Or if you have an author that you liked or that goes in line with your empirical exercise?
I wish I did. I don't. We're empiricists, pure and simple. We go and we see it, we check the data out, and we're more often than not, we're kind of accounting-based empiricists. So we'll examine things, in the context of the balance sheet as a whole. So, I wish I had a theory to bring to you, but I can tell you that everywhere we look, and as rigorous as we look, we don't find a correlation.
So is there a sense in which money supply growth is connected to inflation at all, or is it just kind of nothing? I mean, it sounds like you're saying that there's just nothing there. So, hypothetically, if we could imagine just kind of flooding the economy with a lot of extra money, don't you think there'd be a point at which it would cause inflation, or is it just you can't make a direct connection or something like that?
I have a working theory that I will put out to you that we're just beginning to explore And that is that I think that money that is created by most, in today's world, essentially all money is created by debt, right? Debt creates money, period. And, that can be bank loans, that can be the Federal Reserve, using its debt to buy securities out of the private sector. There's if you think about money creation, it's just a few things. What happened in the past in the United States, but does not happen today, is the creation of money that is not accompanied by the creation of debt. And we know that phenomenon from the American Revolution. We know that phenomenon from the Confederate States of America during the Civil War. They just printed paper and distributed that paper. And we think those are two different things. And we don't hear people discuss that. But when you, and people use the expression printing money all the time, do a Google search for printing money, you're going to get a million hits. What the United States does is not printing money in the way I think about it. I think about printing money as the shin plasters from the American Revolution. I think, it was done in, certain African countries. I think it was done in Weimar, Germany. They printed money that was not debt related. That just kind of doesn't happen anymore. And if you look at the quantities of money that was printed in those circumstances that led to inflation, it wasn't like a 5 or 10% increase in the money supply or a 20% increase in the money. It was a 100% increase in the money supply over 2 or 3 or 4 years. I mean, I think most economic phenomenon is not a matter of a small number of degrees. I think it's huge amounts. You're financing the American Revolution, or the poor Confederates are, and they're lost in a horrible cause, or trying to finance their activity, and they're printing something that's equal to GDP for several years in a row. Well, there's no doubt in my mind in that circumstance, it causes massive inflation. But the scale at which that occurs and the type of money that is created where that happens, to me, are very different than what we talk about every day these days.
Can I just ask a clarification question? Because I didn't quite understand, because I don't know if you agree, but printing money today perhaps is different than it was before because of the inflation targeting regime, when you have to keep the interest rate fixed. So if you print money, you at the end, if you want to keep the interest rate fixed, you have to take that money out at the end of the day, putting new debt on the system, right?
Well, so, I'm gonna offer one more element of heresy here. I think the role of the Federal Reserve in interest rates is overrated, is grossly overrated. The Fed wasn't invented to control interest rates. The Fed was invented to become the lender of last resort in the wake of the 2007 crisis. Somebody just decided that the Fed ought to control inflation, pursuant to the experience of the 70s, which I would argue was entirely related to OPEC's market power. The United States didn't have a central bank ever until 1913. We didn't have inflation. The United States didn't have a national currency from 1787 until 1862. We didn't have inflation. I think I hate to say it too much. I think people's fixation with the Federal Reserve is wholly misplaced. And I don't think the Fed, I think the macro trends in interest rates and the macro trends in inflation have almost nothing to do with the Federal Reserve.
That's very interesting. So I want to kind of explore this distinction you're making between kind of debt-based money creation and debt-free money creation. And I want to see if I understand the distinction that you're drawing here. So obviously the notes that were issued, you know, the Continentals during the Revolution, or the Greenbacks during the Civil War, or, you know, even the notes during Weimar Germany, those were all, in a sense, they were debt in and of themselves, because they were issued by the government and they were promises that you could.
You're exactly right, with two important exceptions.
Okay.
They had no maturity, and this is the essence of the difference. They had no maturity, and they had no interest rate.
Okay.
And that's the distinction I'm drawing.
Okay. So a console, like a perpetual console, it's still debt because even though it has no maturity, it has an interest rate or something like that.
I think that right. I'm not sure I understand that fully myself. And you're obviously talking about a spectrum.
Right.
But I would make the observation that where you have a lot of money creation, a lot, I'm not talking about 5%. You know, I'll give you an example. Dan's here so he can correct me. We created greenbacks in 1862, right? That constituted about 5% of all the money that, you know, that was, or excuse me, 5% of GDP and about 9% of the cost of the war. It's about $450 million. We had about 2 years of high inflation after the Civil War because so much agricultural capacity had been decimated. For the next 14 years, until gold convertibility was restored in 1879, we had deflation. On average, we had about -2% per annum deflation. So I can tell you the creation of non-debt, non-maturity money, greenbacks, in 1862 didn't cause inflation. In fact, there was structural deflation in the economy. So I know 5% money creation of that sort doesn't do it. I think it's 50 or 100% or 150% that does it. So.
Okay. And to kind of follow up on something Natalie was saying, if the central bank buys up the government debt, the treasuries, that kind of thing, does that kind of convert the money into debt-free money because you've kind of removed the debt? Is that like kind of an equivalent process? Like maybe 2 steps to that would be equivalent to the 1 step of just kind of printing money and not issuing any separate debt, that kind of thing?
Perhaps. We've looked at that pretty closely. And, you know, that debt, to the extent it's owned by the Federal Reserve, it has interest rate and has a maturity, but all that goes back to the Treasury in the form of the earnings sweep from the Fed, right?
Right.
So, you know, perhaps that's right.
Okay, now I want to go to Raphael for a question.
Hi, very interesting work. My question was, if we think about money creation as credit, would it make sense to also think about what assets that credit is fueling? So if we think, for example, mortgages, you know, would seem to be used to buy houses, we would see the price of houses go up, but that wouldn't necessarily be captured by inflation because houses is just a small portion of the index. Do you think that dynamics like these could be at play where we do have some bubbles in some specific asset sectors, but somehow not seeing it through the aggregated inflation measure?
I think that's very well put. Yeah, I tend to separate in my own mind and in my writing, I tend to separate asset inflation from consumer price inflation. And obviously they're not totally delinked, but as a practical matter in the everyday experience of a household, I think they largely are delinked. And there is no question that rapid loan growth, at least initially, creates rapid growth in asset valuations. I think that's one of the most fundamental things to understand about any economy. So yes, I think that's right. But I tend to, in my own mind, I tend to kind of put that in a separate bucket. that asset inflation leads to a lot of things that aren't that desirable. It leads to increased inequality. I think that's what we've been seeing lately. It often leads to a financial crisis. So, that's really one of the things we look most closely at is growth in credit. And your first point, I think, was an excellent one, which is you can't really think about the growth in debt in isolation from the growth in the corresponding asset. So what we've been developing lately are just, national balance sheets for the big seven countries, and always try to think about it in the context of what's happening on both sides of the balance sheet.
Okay, let's go to Dara or Dara. If you're there. Well, the question, yeah, there you go. Go ahead.
Well, you can read it. So, okay, I'll read it. I'm wondering if the rise of fiat currencies affects your historical interpretation.
So help me a little bit in defining what you mean by fiat currency.
Something that's not based on gold, silver, whatever, is disconnected from a hard asset, which can be called to make good on the currency. Got
it. Yeah, I mean, it doesn't affect it a lot. I think, when I study, we tend to look back in time pretty far as we can. We tend to cover the Industrial Revolution forward. So, we're thinking about, the British crisis of 1825 and the Bank of England, this, that, and the other. It's really hard for me to find too many periods that are like pure gold standard periods. There's a lot of departure from the gold standard as a practical matter. In the 1820s and 30s in the United States, you have the rise of state banks, after Jackson has impinged upon the Second Bank of the United States. A lot of that's wildcat banking. It has nothing to do with gold. And those banks are creating money because, as you know, in that period, the proceeds of a loan are the unique currency issued by that bank specifically. So, maybe a little, but it doesn't really, I think, affect my fundamental thinking about inflation. I think that the connection between gold and money was always pretty tenuous from the inception of the Industrial Revolution forward.
Okay, let's go to Jay.
So thank you, Richard. Thank you.
Thank you.
Hi, Richard, and hi, Dan. It's good to have you. Really, really interesting discussion so far. I had something in the context of this group and in how we think about inflation. I've been thinking about a lot, and I just putting two or three things together that you already mentioned, and trying to just add the issue of globalization as a general phenomena and how it relates to inflation. But so I've been thinking about this issue in the following terms. Our standard theories of inflation have been developed when the national state and globalization were not fully developed to the scale we have currently. And you already mentioned that we see inflation much more as a phenomenon in developing countries than in currently already developed economies. So those are points you already raised and explained well. So we could take it, and something that I've been thinking about as well is that we basically have, with China and the global integration of our supply chains, we have much less propensity of hitting any sort of supply side constraints that you would hit in previous decades because we don't raise prices with increasing demand and credit growth or whatever. We look into those phenomena. So if we take this, if we basically say globalization in China is a big sort of deflationary sort of factor in CPI, especially, then we basically have a completely different way of contextualizing that. We basically have to look not at individual countries, but we have to look at how these countries are linked up and basically look at them together, because obviously what would have appeared previously as wage growth would now appears in China, not in the US sectors, for example. So I'm just wondering if this sort of narrative fits the story you're telling as well. This also kind of explains developing countries, because they're not linked into the supply chains fully in the same way that we see it between, say, the United States and China, for example. Just wanted to get your take on that.
Yeah, I think you're making two really important points. One of them is you kind of have to look at the world as a whole, and the rise of China from roughly 1980 forward is a massive factor in the whole thing. And one thing I do believe about inflation is that if you produce too much, it puts downward pressure on prices, right? That's pretty simple, straight ahead concept. And China has been a produce too much machine now for 20 years, and they're still producing way too much. And, to keep their kind of political system from, prevent it from unraveling, they're locked into this game. So, yeah, that's a huge factor. And, as China kind of slowly comes back to earth, which is kind of our prediction for China, that GDP growth has to kind of fall back, whether it takes 10 or 20 years or 5 years, probably more time rather than less, where they come back to a more pedestrian GDP growth rate. I feel like that's going to be a profound factor. At that point in time, they're either going to be a close second or maybe even the largest economy in the world. They've got that little population problem to deal with. We can talk about it at a different day. So I think you're exactly right. And that's why. So Dan, I know I got this wrong earlier. Those 7 countries we look at add up to what % of GDP?
Morning, Richard. Morning, Alex. I think it's about 80%.
So you got 7 countries that constitute 80% of world GDP or close to it. So we focus like a hawk on those 7 countries, which includes India, which we think is going to be a bigger and bigger factor. Little countries kind of get whipsawed by those guys, and not being, Jay, you made the point, not being linked into the global supply chains, part of that. Having current, foreign capital rushing in and out of the economy whipsaws them. If they have a trade deficit, that it puts downward pressure on their currency, which puts upward pressure on inflation. My advice to a small country would almost be the exact opposite of what the IMF, World Bank advice has been. I would say, don't ever borrow in a foreign currency. Do everything it takes to prevent yourself from having a trade deficit. Do protect infant industries with, whatever kind of protection, tariff or otherwise. You can build up your own internal IP and capacity. The way the IMF and the World Bank advise them just sets them up for all sorts of problems. And by the way, the formula I just gave is the formula the United States used in the 1800s. The United States was the most protectionist nation on earth for well over 100 years, until its internal production sophistication had reached a level where it could compete with anybody.
Yeah, it's an interesting point, because if you're depending entirely on imports, you have no reason to develop your own productive capacity. Let's go to Bruce.
Hi, good morning. Can you hear me okay? Thanks. Richard, thank you very much. This is really interesting talk, and I'm very much looking forward to reading more of your work, because I find everything you've said today really compelling. I have two quick sort of unrelated questions, but I think they tie into what you've been saying. Number one, you mentioned earlier, if I understood you correctly, that you think the Fed gets sort of too much credit, if you will, for interest rates, et cetera, if I understood that. But I want to ask you, a lot of what I'm reading in sort of maybe it's just the Twitter sphere or fin Twitter, whatever you call it, but there seem to be some economists out there, I think most of them are sort of in the MMT crowd, but they say that interest rates are a policy variable, that the Fed can always set rates wherever they want, anywhere they want on the curve. And it's sort of silly to argue that there's anything like market rates, because they're policy rates. So that's my one question. And my second question, if you don't mind me asking too, is similar to the issue where you said the Fed has less control than we think it does. I think back to some of the things we've been seeing lately with, and maybe it's more because of the Fed in its regulatory guides as opposed to interest rate setting, but like with the rules around the G-SIBs and I guess Basel rules that the Fed is helping implement. It seems to me a lot of them, at least the major money center banks, are pretty constrained in what they can do. And there's talk of them sort of increasing and decreasing either loan creation or margin loans to Wall Street participants, just based on, you know, reserves flooding in and preventing them from doing other things with their balance sheet that they might otherwise want to do. But they have absolutely no control when the Fed decides to do QE and flood the system with reserves. Suddenly the bank's balance sheets get swamped with reserves, and they have to get rid of other assets, whether they're treasuries or loans to brokers, etc. So I just wanted to get your perspective on those issues, if I understand them correctly.
Yeah, I mean, I think you asked more than two questions, and they were all great. And I think they were all great questions. So forgive me if I miss something in responding, but I actually think you're on to something when you talk about the Fed's regulatory apparatus. I think the Fed's regulatory apparatus and its capital rules have far more significance than the monetary operation side of the Fed. I mean, the Federal Reserve regulators can, I think, for example, could have been more assertive in 2005 and 6 and 7 and prevented some, most, all of the bad behavior that occurred. If not, the Dodd-Frank has certainly given them additional latitude that should allow them to do that going forward. And there's a lot of things that Dan and I have done that where we tried to get data from the Fed. And so, for example, we're very interested in getting data by a sector within lending. So we want to know the difference between healthcare lending and energy lending, because a run up in energy lending debt probably means there's going to be an energy crash.
Yeah.
A run up in IT debt probably means there's going to be probably a tech crash. So we called the monetary policy side, the research side of the house, and we said, do you have that data? And they said, no, but they probably do over on the examination side. So we called the examination side, and they say, no, we don't have that, but they probably do back at on the other side. So I have a sense that these two parts within the Fed don't really work together. So they can influence a lot the behavior within the economy. Okay. Now, you made the point. I mean, the government just created something on the order of $3 or $4 trillion in new money, and I think that was one of the things you were referring to. And banks do have this problem because most of that shows up in the form of deposits in banking accounts, and banks have to take extraordinary steps at that point in time. But there are steps they can take, like not paying interest, or charging higher fees. The banks can manage. I was a bank president for 30 years. So the banks can manage through that. It's a pain in the but they can manage through that. Now, back on your first question, which is MMT and interest rates. And by the way, I have all sorts of respect for, much of the work that the MMT folks have done and the causes they've championed. And a lot of those guys are my friends. And, I have disagreements with some aspects of what they do, but I have great respect for many of the things they do. So, but their point on interest rates, I think, would be more compelling if there wasn't the rest of the world. So, if you had an entirely closed system and there weren't such things as trade and the ability to move capital and debt across borders, I think it'd probably be more true. I would temper my earlier statement by saying, I think over the short term, the Fed can do just about anything it wants with interest rates. But their ability, the issue comes in their ability to sustain that. Okay. If the Fed wanted to, it could move interest rates up to 10% or 20% tomorrow. And that could go on for a few months or maybe in a couple of years. And then the economy would just crater, right? And, they could do the opposite. They can move down to -5. I think ultimately it's the economy, in spite of the Fed's considerable power to do things over the short term, I think over any longer horizon, I think there's a reality that constrains that and is more important in dictating interest rate trends.
I got you. Thank you very much. It's really helpful.
Thank you.
Yeah, that's an interesting point. So paying attention to the real constraints that the central bank and the government in general face. They can decide whatever they want, but if they decide the wrong thing, then the economy is going to come back and bite them or something like that.
Yep.
So I have a question which is related back to the money supply issue. So Milton Friedman and the monetarists tend to think of money supply as a stock, how much money is out there in the economy, and that's also what you're looking at when you're studying money supply growth, as the data in your article. So my question has to do with, like, there's got to be some connection between money and inflation, right? Because inflation is an average of prices, and prices are how much money is going to buy something. Now, if you think about, kind of the average price level, you have, the level of spending matched up with the level of economic output, how much money is going to buy how much stuff. So there's a relationship there, right? And that relationship is the price level. So if we think about money supply as kind of the flow of spending going towards the stuff, is there then, like, can we then say that there's more of a connection between money supply when framed that way as connected to the price level, and then maybe kind of what you're getting at a little bit is that there's a disconnect between the amount of money out there and the level of spending in the economy? Does that make sense?
Yeah, I would I think there's value in what you're saying without question. I would frame it a little differently, and that is that I actually have gotten in the habit of thinking of lending trends rather than money supply trends. I think money supply is the shadow of the thing, and lending is the thing. If that makes any sense. And so I think if I say lending growth and you in the back of your mind realize that in some respects I'm talking about money supply growth, I think lending growth has a massive impact on demand. And I think that's one of the things that tends to be at least somewhat neglected in discussions of demand and supply. And you might think that, if there's no demand, you might think, for example, that if there's already too many houses, how could there be more demand for houses if we already have 1 million too many houses as we did in 2005? And I'm here to suggest that as long as lenders are lending, demand will continue to increase in the form of money given to builders and home buyers to buy more homes that nobody needs. That was the core phenomenon in in that. So credit growth, loan growth is a factor that's not included in most analysis of supply and demand. And I'm going to argue that it's one of the most important factors. As long as lenders lend, and I've known a lot of lenders in my time, and most lenders keep lending beyond the period that they should be lending. So, you know, to put it bluntly. And so demand keeps increasing at a point beyond which demand should have stopped. But most of that, kind of to our earlier discussion, most of that historically, not all of it, but a disproportionate amount of that has always surrounded real estate in particular. I don't want to oversimplify too much, but you know, we've looked at 43 crises over 200 years in 6 countries, you know, so we can't really find much in the way of an exception to this. And so that demand translates into asset inflation rather than price inflation. I'm not going to say there's no connection whatsoever. I'm just thinking that's where it predominantly falls.
That's an interesting point. And what do you think is the mechanism behind that? Is it that people need homes, so we make it easier to expand credit that would allow people to buy homes, but then that simultaneously just goes into the price because you know, people have more money to spend on real estate, that kind of thing?
Yeah, it's a pretty, I mean, I'm going to talk about the technical issue and then the social issue. And the technical issue is if more lenders are making more mortgage loans, then there's going to be more buyers for your house when you put it up for sale. And that's about as straightforward a phenomenon as any of us can imagine. If you have one buyer for your home, you got no price leverage. If you have 6, you can probably sell it for more than you listed it for. So it's that straightforward. The kind of the more social emotional dimension of that is that whenever I start lending more than trend, the first thing that happens is things get better or seem to get better. Prices go up, my paycheck goes up, more people are going out to restaurants, I get a promotion, my stock price goes up. So, you know, the early part of any boom kind of starts feeding on itself. And at some point in time, that formula gets locked in, and that's when trouble starts.
I see. That makes sense. So Dara has a question in the chat. He's asking, did Vietnam use the same formula for internal development that I suppose the United States did in the 1800s? He's asking.
I'm no expert in Vietnam. I think little I know, I think that's true. I think China did a lot of that too. You know, the folks that have tried to do business in China have basically had to give their IP free of charge to China as the cost of doing that. So China's kind of taking care of itself, and I think Vietnam is had sort of that same aegis as well.
Okay, let's go to Natalie.
Yeah, me again. Sorry, Richard. I just wanted to come back to the question of the interest rate settings, and it relates to a question that I think we always ask people that come here to our group. Because, okay, as you said, the central bank or the Fed can set the interest rate, but it is restricted to real side variables, or maybe post-Keynesians or MMTers will say a policy restriction. For example, the inflation targeting regime. That's again my question. So if you set your interest rate according to the inflation rate, that will be a constraint to the level you set it in. But your paper shows that there's not much relation between interest rates and inflation. So I think the question is, where should it be directed at? If it is a policy variable, where should it aim at? Would it be credit, as you are just talking right now, or what will you say?
I think you've raised an excellent point, and I think that would be a viable target. That would be a better target for the Fed. You know, if I was over the Fed, which of course will never happen, but if I was over the Fed, that's exactly what I would do. I would monitor credit trends within the economy because these trends are not subtle. You know, as you guys may have noticed, we had this massive energy debt crash in 2015 and 2016. And I think energy debt was growing at, you know, kind of 100 to 200% a year for 3 or 4 or 5 years in a row. It wasn't these subtle differences you have to get your microscope out. They're big changes in trends within categories. And if I were the Fed, that would be the thing I'd pay most of my attention to.
So talking about central banks, do you feel that it's important that central banks pay attention to the price level? And do you feel that central banks have been successful at promoting price level stability? You mentioned that all the developed economies haven't really had any inflation to speak of. Is it a coincidence that inflation in developed countries has been fairly low and steady in the past few decades?
So I actually think that there's an inverse correlation between debt growth and interest rates. That's what I think. The more debt you have, the lower interest rates go. Now that bounces around, but just, you know, we've often published a schedule of, you know, for the United States, for China, for Japan, for Europe, kind of a synthetic aggregate Europe, which really covers, you know, 80 or 90% of the world's GDP. We've created a chart from, you know, roughly 1950 forward. And all those charts look about the same. There was little or no aggregate credit growth to GDP up until kind of 1980. And that was a period in which interest rates were generally rising. And since, call it 1981, it was a little bit different year in each of those economies. Interest rates have been falling now for 40 years, 40 years. And during that time, debt has doubled in ratio to GDP. It's gone from 125% of GDP in the United States to 250% of GDP in the United States. And interest rates have gone from what, 15% to 2%. That's not just in the United States, that's the whole world where that's happened. So it's hard for me not to conclude that the more debt you have, the lower interest rates go. Oh, Dan, here's the chart for the United States. And I don't know if y'all, you know, Dan, take us to 1981.
Sure. So we have 2 scales here. Left scale being the total debt levels. The top bar is total debt as a percent to GDP. The middle dotted bar is private debt to GDP. And then the longer dotted bar is public debt to GDP. And the more the lines, we have inflation, long-term interest rates, and short-term interest rates on the right-hand scale. And if you focus on about 1981 is when that inflection point really starts, when debt goes up and interest rates go down.
And that you'd see basically the same chart if you looked at these other major economies. So I kind of think there's an inverse. And as I get into the literature, particularly writers in the 1800s, I love reading economic theory as written by authors. You know, Condé Reguet, who started the first savings bank in the United States, basically writes, the more money you have, the more plentiful money is, the lower interest rates go. And he's writing in circa 1837. And, you know, this was kind of an assumed principle. And as we talked about early in the discussion, the more debt you have, the more money you have. So I think you can take that down now, Dan, but thank you for sharing that. But I think, generally speaking, there's an inverse correlation. And if you felt differently, I'd ask you to show me some situations where that was the case, because we haven't found it. And you may have noticed in that graph, things bounce up and down by a couple of hundred basis points. So, it's not physics, but the general trend is downward.
Yeah, I think it makes sense that you'd see an inverse correlation between interest rates and credit growth, because if credit is cheaper, then you'd expect the economy to be creating more of it, right? And then I also suppose it depends on.
Milton Friedman just turned over in his grave when you said that, by the way.
Well, it also depends on what's driving what, right? So if there's a lot of credit, that might create a reason for the central bank to raise interest rates and tighten monetary policy. So if the amount of money or the amount of credit out there is causing a need to tighten, then you might expect the correlation to go the other way. But I think what you're showing in your data is that it's the other thing, is that the price is driving the amount of credit. That's what we're seeing in the economy, and that makes sense to me. So let's go to Raphael again. Question about monetary velocity.
By the way, I forget this gentleman's name, but there's this extraordinary scholar, and he's probably a YSI member, frankly, and you've probably seen his presentation, but the downward trend in interest rates is now probably 6 or 7 centuries old. He's got good, solid, primary source data going back several hundred years, and the general downward trend in interest rates is pretty lengthy at this point.
That's quite remarkable. Does he have a reason for that?
Now, he doesn't spend any time talking about reasons.
Okay.
He spent, his scholarship relates to actually finding original sources, going back to contracts from the Fuggers or the Rothschilds or whomever, and getting actual data and plotting it. And his rigor has been around that. I haven't heard his comment, but he might not disagree with us that the more there is, the cheaper it is.
Okay, cool. Let's go to Raphael.
Yeah, I think I've read that paper, and he goes back to medieval times, which is just pretty crazy. So that what you're saying makes a lot of sense. My question was about velocity of money. I'm sorry, I think it's probably a very basic question. I'm still trying to wrap my head around all these concepts, but do you think it's relevant to the story? The link is broken because the velocity is low. The link between money creation and inflation is broken because velocity is low, and we should understand velocity? Or do you think velocity, since it's not really something you directly measure, is really whatever it needs to be so the equation holds? Do you think it has any explanatory relevance?
My problem with velocity is that there's things that can change velocity unrelated to what you and I would think of as just the amount of spending going on. So for example, we've seen one of the biggest of those happen just here in the last year, when the Fed buying, spending $3 trillion, the government, the Treasury spending $3 trillion, and the Fed buying all that debt created $3 trillion in deposits. Well, that affects the velocity equation. It makes velocity look like it's lower when in fact, it's. The other thing that dramatically affects velocity is the trade deficit. Our net spending in other economies actually shrinks the deposit number. So those are the bank lending, Fed buying of securities, and trade deficit are the three biggest elements of the deposit creation formula. So I kind of try to disaggregate that when I look at that, and I don't think just the naked velocity statistic is one that I trust particularly.
Thank you.
Okay, so I want to talk about today. What are your thoughts on what's happening with inflation now as we're coming out of the pandemic?
I would tell you that I expect kind of a reversal and upward pressure on inflation because of supply disruptions. I mean, the supply disruptions right now globally, you know, in the US and globally are almost embarrassing. They're so bad. You know, I have builder friends who have doors and windows that they're importing from China from things they're building here in Philadelphia that have been sitting at the dock, you know, under an inspector's seal for like 10 weeks, you know, 15 weeks. We have, you know, I'm sure y'all are experiencing, you know, books that I used to get the next day on Amazon, I might get, you know, a month or two later. I've tried to buy some sports jerseys for my kids for Christmas. You know, we have a basketball team here that's doing pretty well. So that was my big Christmas gift idea. I just got them in April. So I order them in the first week of December. So I think there's just massive supply disruption that's happening. And I think that's just part of the story. But I expect we got a couple of years of, you know, a lot of disruptive behavior in both supply, inflation, interest rates, and the like before things settle back down.
Okay, I guess we'll see how that bears out. So we're getting towards the end of the hour, and I want to be respectful of your time and Dan's time, but we do have a couple more questions in the chat. I don't know how flexible you are.
Let's take them.
All right.
If they're easy, I'll take them. If they're hard, no, just kidding.
So Dara has a question, which is, do you see different effects between private debt versus government debt? And I guess, you know, so what are the important differences between private debt and government debt? Is there a trade-off between the two?
Yeah, you know, it's a question we study a lot. It's very central to our thinking. And we think, it'll come as no surprise to this group that we think private debt, the impacts of private debt are much more important and much more profound. If a business owes, you know, $1 million to a bank, it's got to pay for that out of earnings. It can't print more money. It can't credit accounts and make repayments that way. And the government can. So there's this very profound difference between, in a country with monetary sovereignty, there's this very profound difference between government debt and private debt. And we pay a lot more attention to private debt. One of the questions you provided me, Alex, in advance that's perhaps related to this is kind of the trade-off between the two. And it is, the question was a great one. It talked about the fact that often improvements in government debt come at the expense of rises in private debt and vice versa. And that's hitting the nail right on the head. This is something we've studied extensively. And we find in major developed countries, we find almost no instances where there was meaningful improvement in private debt ratio and the public debt ratio. So, you know, countries like Japan and soon to be the United States that have a whole lot of both really are the ones that have to start thinking hard about Jubilee.
Okay, and Demo has a question about the shape of the yield curves. Demo, do you want to ask that question?
Yep. Yes. Hello, everyone. I'm interested in the shape of the yield curve and its effect of the asset price inflation, because in my opinion, it should matter.
Yeah, I'm not sure. I mean, there's obviously a whole lot implied by that question. You know, I think generally yield curves should be upward sloping. The further out in time you get, the higher the rate should be to accommodate, you know, event risk, credit risk, uncertainty, all these things. We know that an inverted yield curve is almost always, not almost always, but quite often a predictor of recession or financial calamity. So, you know, we do pay a lot of attention to the yield curve. Longer term rates over time are much more stable and I think indicative of underlying trends. Short term rates can bounce up and down a lot more. So I don't know if there's any particular question beyond that that you have, but those would be just my general observation about yield curves.
Usually, I think that the short-term part of the yield curve is kind of static. And when there is a profit opportunity for the financial institutions and the long-term rates are high, usually we see the long-term rates going downwards in periods when there is inflation, especially asset price inflation.
Yeah, I think that's correct. I think that's correct. And there's an arbitrage there that, you know, there's a whole lot of Wall Street that just makes a living on that arbitrage. So I think that's a great observation.
Okay. So any final thoughts, Richard or Dan?
I would say thanks to Dan for joining me. Dan's the one that does all the real work around here. So we're certainly available for any other questions you guys have. And I would reiterate what I said earlier. Jay, you've done a wonderful job leading this organization. It's a privilege to be involved. Alex, you've been so helpful to us over the last few weeks, and it's been such a pleasure to get to know you. And I look forward to seeing you folks down the road.
I would just like to add, all of our data is available at debteconomics.org. Feel free to check it out and let us know if you have any questions.
All right, debteconomics.org. Thank you guys so much for joining us. This has been great. I'm going to stop the recording here.
Thanks again. This was a great discussion. Thanks, Dan, in particular.